meeting for Tuesday, October the 30th. And our first order of business, I guess, is Wes with the investment report.
Oh, yes. So, as you know, I was like, was there a report, investment report? I was like, I don't know. So, as you know, we hired Chandler, I think it was in March of 2018. So they've been on now for about 9 months, so we figured we'd bring them in and have them give you a presentation.
And this is this gentleman?
And this is Jason Smith from Chandler. We have Mia and Kara, all from Chandler.
Oh,
And Jason
wow.
will be presenting, I think, the quarterly financials
Must be
for
good
September,
news.
correct?
Correct.
we must be making a lot of money if 3 people show up.
Hopefully we are.
Okay.
So Jason's gonna give a presentation on our quarterly report.
So I'll take one step back and I'll introduce our firm and talk a little bit about the folks that are here and their roles. So we're with Chandler Asset Management. We're a San Diego investment advisory company specializing in public agencies. Our founder is Kay Chandler. She started the business in 1988. We've grown, I've been there almost a little over 20 years now. We've grown from about 600 million when I was there to almost about 16 billion at this point. And across California. And I have here Kara, who works on a lot of the quarterly reports and things like that, and also Mia, who is really looks on the client service aspect of that, making sure that all of our clients are getting what they need. Myself, I'm Jason Schmidt. I'm your portfolio manager, and I'm the person that's responsible for purchasing all the investments and making sure that the portfolio is invested to the strategy.
Did we meet one of you when Wes, when you,
When we hired them, they came to the board meeting.
Yes.
Yep.
Uh-huh.
Okay. The lady looked familiar, but I don't, were you there as well?
Probably not. I probably was
Okay.
not.
Ladies look familiar, and as you get older, you just think I've seen them before. I'll get you in trouble.
I think Kara and I kicked off the relationship at the board meeting.
Right.
And
Yes.
so we mentioned that we would be back, and so we thought it would be nice to have the entire team back today.
And one of you guaranteed us the 8%.
Yes.
All right, and with that, what I'd like to do is just talk a little bit about the portfolio. So I'm going to give you a quick economic update, talk about the portfolio itself. We also, not only do we manage some funds for you, but we also report on a consolidated basis. So some of those different cash balances and things like that that you have, we'll also be reporting that. We'll show you every single individual holding that is in the portfolio, being perfectly transparent, and then we'll also show you the transactions that occurred during that period of time during the quarter. And so let's take a look at what's going on in the economy. We all know that there's a rising interest rate environment, i.e. the Federal Reserve continues to raise the federal funds rate. It did that at its last meeting. It rose that to 2.25%. Since that period of time, I'm glad I'm presenting September 30 numbers, and I'm glad that you own basically bonds and not stocks at this time, because I think we all have seen in the papers where things have gotten a little bit more volatile than we've seen in the past. And so what we've really looked at now is, from the Federal Reserve's perspective, is we do think that there's a high likelihood that they're going to raise rates another 25 basis points. This would be at their December meeting. That would make the federal funds rate go to 2.50%. And the Fed has mentioned in its communications to the market that really that rate that it thinks is kind of the normal rate right now, for given the economics that we have, is probably around between 2.5% and 3%. So we think that there might likely be another raise maybe in the March 2019 meeting, but then after that we think that the Fed may actually tend to pause at that point, in the sense that it's getting close to its targets. The economy continues to do well, and we'll have to see as far as what it's going to do there. Remember that inflation, it has two really primary mandates: full employment, and I think that most of us today, although we'd like to see our wages go up maybe a little bit higher, the majority of people can find a job today. There's a lot of employment that's going on, not only here regionally, but if you look around the country, things are going well. So I think full employment is doing well. And then inflation. Inflation, although prices have gone up, and I know in California we kind of judge that off of gasoline prices sometimes, and those have gone up, but they haven't gone up to an extent to where it's gone out of control, meaning that it's not within the Fed's really defined targets, and I'll show you that a little bit later. Looking at the economic data, and so what you can see is that we had for the third quarter, that's annualized growth, 3.2%. Remember the quarter before that, it was above 4% over that period of time, so the economy continues to expand. I'll show you a little bit more detail on that moving forward, but we continue to see a pretty robust economy, an economy where we continue to see accelerating growth. And then also looking at the yield curve, and so if you look at just as of September 30, the 2-year Treasury note was 2.82, the 10-year Treasury note was up 20 basis points, or 0.2% up to 3.06. Remember, for your portfolio, although we have longer term rates, 5-year maximum maturity. And so that is the maximum maturity. And also, if you think about the average, it's going to be between 2 to 2.5 years. So that's why that 2-year note is very important to you as far as looking not only at how your portfolio is performing, but also some of the reinvestment rates. And so I'm going to show you some numbers of the market value of your portfolio moving forward, and we'll also talk a little bit about those at the same time. Looking at just the employment, so what you can see is that this was back in September. We have another employment report that actually is going to come out this week. But 134,000, that disappointed the market a little bit, but there was something in that. Something rolled through basically the United States, and that was basically some hurricanes rolled through the United States. Typically that temporarily puts a damper on employment growth. But if you look over a longer term basis, we're averaging every 3 months, usually around 200,000 jobs. And then on the other side, what you can see there is the unemployment rate. The darker green line there is the headline. The lighter green line there is what we call the underemployment rate. Those are those folks that would like to be working full-time but maybe be working only part-time. And you can see both of those are pretty much at relatively low levels, especially since over the last 2 years. If you look at the unemployment rate, the headline number, that's under 4%. And so if you look at that, you really look at what the available labor force is, you're starting to see that the amount of workers that are out there, even to employ, is starting to shrink. Also, we saw year-over-year wages up about 2.9%. And one of the things that's been going on in the economy is basically wages haven't been growing like we've seen them in the past in these types of recoveries. There's lots of different theories that are out there. My theory is this. One, we have a lot of technology that's taking place. So with that, basically, you're seeing that can depress wages in some way, and that substitution effect for employers and things like that is probably greater. Also, we have demographics changing in our country at the same time. So those two factors together, I think, are putting a little bit of a damper on wage growth, but we're definitely seeing at levels that we haven't seen in a while here, so that is a good development there. Looking at inflation, so remember the Fed's mandates, full employment, stable prices. And so the CPI index, or the Consumer Price Index, is a national average of prices. You can see the darker green line there is the headline number, and then that lighter green line is what they call the core CPI. And what that means is what are some things that are volatile as far as prices? Well, food prices are volatile depending on seasons and things like that. The other thing they extract out of that number is gasoline prices, so that they can get at the core number there. And you can see that that's a little bit above 2% there, but definitely relatively below its long-term averages. But the Federal Reserve, when it looks at inflation, has its preferred measure, and that's the personal consumption expenditures. So this allows for substitutions of goods and services, also looks at GDP a little bit more. And what you have there is the lighter green line there is the core number, which is X food and energy, and then the headline number, which is the darker green line. The Fed has a target for inflation. 2% is that target. It's meeting its targets. If you look back, it had been below those targets, especially on the core side of the equation. And that's why you're seeing the Federal Reserve act, meaning that it has had what they call an accommodative monetary policy, where it continued to keep rates low for a longer period of time in order to really stimulate the economy. Now it's reversing that. And so with that, we're seeing where it's doing that really to stave off inflation in the future. One of the things I want to take a step back and talk about is the Federal Reserve. We always talk about, when we talk about the Federal Reserve, really is interest rate increases. But remember, one of the things that the Federal Reserve did do also was what did it do? It purchased a lot of our own bonds for its own balance sheet. So its balance sheet at the beginning of the Great Recession, which was back in 2007, was at $800 billion. And we all thought, hey, with a balance sheet like that, we could take care of any kind of economic situation. Well, as that progressed, basically the Fed started to buy a lot of these different securities in order to help stimulate the economy, because it already put interest rates basically at zero over that period of time, so it really lost one of its main tools. So its balance sheet, by doing so and purchasing those bonds and putting more cash out into the economy, ballooned to about $4.6 trillion over that 8-year period. What it's doing now is basically, on a quarterly basis, it's targeting basically reducing its balance sheet by $150 billion per quarter. And so what this is doing, if you think about rates increasing, so you have rates increasing, and then you also have the Fed taking money out of the system basically by not purchasing those bonds, it's really a pretty big tightening cycle that's happening, and yet the economy continues to grow at that 2.5% to 3% level. So those are some of the things when we look at it will affect interest rates also, because if it's not purchasing Treasury securities, if it's a big demander of Treasury securities, and we all know from supply and demand, economics 101, something has to happen to price when supply and demand change. We probably are seeing a little bit of an upward bias on interest rates, and we also might see longer term interest rates increase a little bit more than shorter term interest rates in the future, and I'll show that a little bit later also. Looking at the consumer, retail sales on a year-over-year basis here, you can see that they continue to be at some of those higher levels. We did see a little bit of a slip-off here in September, but typically what you see is that things decline a little bit, and then what are we heading into? That great consumer season that we all like in the United States, which is the holiday season. And so we'll have to see what happens, but right now consumer confidence is very high, and so a lot of people are forecasting this could be one of the largest Christmas seasons that we've ever seen, or holiday seasons. In fact, I've seen analyst reports that in this time period, we actually may see consumers actually spend more than $1 trillion over that period of time, which is the first time that we would have that sort of activity, so on a nominal basis. So people are projecting a lot. Let's see if that really comes true. Then looking at consumer confidence, and so you can see on that basis things continue to go up. Actually today we got another number which is actually higher than that. Consumers continue to be confident. One of the things, this is a survey that they give to consumers that they talk about stable job growth, continuing to see kind of a wealth effect going on from their homes and other types of things, low gas prices, and so consumers, as far as the situation that they feel now and what it could be in the next 6 to 12 months, is very stable to improving. Consumers are continue to be pretty robust on this. Looking at economic activity, leading economic indicators, what I really want you to take away from there, anytime you have a negative number for 2 or 3 consecutive months, that's typically indicative of an economy that's slowing or potentially going into recession. What do we see here? I can't find a negative number. So what I would have to say, just looking at that in a vacuum, is essentially that over the next 6 to 12 months, I wouldn't forecast that there's a recession or even a dramatic slowdown that would happen in the economy. If you look at the Chicago Fed National Activity Index, this is looking at 85 different indicators, so it's a broader measure. And what I want you to take away from here is the 0.7s. Anytime it's above 0.7 for a period of time, that's inflationary. So maybe you're getting some inflation. Anytime you're below 0.7 for a period of time, that's potentially a slowdown or maybe even recessionary. And where are we at? Kind of that Goldilocks scenario today, to where we're kind of right in the middle there. So using these two numbers, which are more leading economic indicators, I would say within the next 6 to 12 months that we really can't forecast a very large slowdown in the economy unless we receive some sort of what the economists call an exogenous shock, meaning something kind of shock to the system. Oil prices go up for some geopolitical event or something like that. But the data we have today, I would project that we continue to have a growing economy. Looking at housing, that's one of the areas that we've seen some weakness in general more recently. So what you can see here is housing starts, and so you can see at that 1.2 million units, we've kind of been stuck there for the last 2 years. And so the darker green line there is single family housing, the lighter green line there is multifamily, and it's been kind of stuck there as far as the number of starts. The other thing that's happening, and this is the S&P Case-Shiller 20 City Composite Housing Index, a long name for something that says what's the national average of housings? Are they going up as a percentage on a year-over-year basis, or are they going down? They continue to increase, but they are increasing at a declining rate. And some of that is what happened is if you look at the affordability indexes, so this takes into account what your monthly mortgages can be. Remember that if you look at 30-year mortgages, how many of us got a 3 or 4% mortgage? A lot of us refinanced our home and got that. Try to do that today, you get a 5% mortgage. And so that's counting against affordability. Also, the rise in housing prices is also counting
Quick
against
question,
that.
all of your information here is total countrywide, not regional.
Yes, it
The
is.
housing starts is not regional.
No, in fact, if you take a look at California in general, probably the housing starts number there is lower than that of the national average, and that's why we've seen more price increases, especially on the coast, including
Right.
California. And some of that has to do with if you talk to different municipalities up and down the state, some of that has to do with regulation. There is if you kind of watched the gubernatorial races and some of the state senate races that are going on today, one of the things they're talking about is affordable housing. How do we get more affordable housing? There is a bill that went through the assembly. I'll have to email it to you. But essentially what it says is that in some ways you can actually circumvent the local building laws if you don't actually have certain ratios that you're meeting for population density and the amount of housing. There's a landmark case that's going up in Cupertino, which is in the Silicon Valley. A developer wanted to basically develop about 2,500 units up there. The city would not allow them to do that for different types of reasons. So now there's a court case and they're using this new assembly bill to see if they can't circumvent some of the building laws in order to build that. So we'll have to see. There's some interesting things that are going on as far as the different laws and things like that, maybe to ease some of this housing.
Do you happen to have any specific numbers on California?
I don't, but what I can do is I can email those to your staff and they can
Terrific.
forward those on to you, because we
Yeah,
do
please
definitely
do.
watch that. So
And I'd like to get that bill,
sure,
it's California bill.
it's a accountability. Yes,
To follow that so we know what's going on with that.
sure. I'll definitely get that for you, and I'll forward you the article as far as the most recent one that we have, as
Great,
far as
thank
where
you.
that case is going.
Thank you very
I told
much.
you that housing would slow down as soon as I bought.
And then looking at manufacturing, Institute of Supply Management, these again are national levels, but if you look at that, we've had all these tariffs and things that have gone on, and it has disrupted some things. In general, though, you see manufacturers continue to be at that higher level. So what the Institute of Supply Management does is this is looking at the people that purchase the nuts and bolts for all the things that we make, this table, potentially cars, some of the valves that are on, that you purchase for the district. And so that's at, some of its highest levels. And anything below 50 is contracting, anything above 50 is expanding. I can't find a number below 50. I hate to paint a rosy picture, because we all know sometimes that rosy pictures, but definitely the numbers that we're seeing today in the economy show that we're continuing to grow. Now, will that be the same thing in 18 months from today? We'll have to see what that happens, because we know the economy is cyclical. Looking at industrial production, that really mirrors what's happening in the economy. So if you look at September 2016 to now, you can see year-over-year growth is over 5% today. So it continues to expand and at an accelerating pace. Looking at gross domestic product here, and so this is looking at the second quarter here. So the second quarter, you can see, was at 4.2%. We just got a reading of the third quarter, which was 3.2%. If you look at the graph on the other side, the bar graph there is the quarter-over-quarter changes, and you can see the green bar there is the year-over-year changes. And what you can see is we continue to increase. We're almost at 3% on a year-over-year basis as far as expansion of the economy. We could probably say the low point was back in June of 2016. Remember, that was right before the election, and after the election we've seen some pretty good growth in the economy. And then looking at bond yields. So how does this all economy boil down to your investment portfolio? That's really set the stage for what your portfolio can invest in. Your portfolio can invest in fixed income assets that are authorized by the California Government Code that are 5 years to maturity or less. And so this includes high-grade corporate bonds, U.S. Treasuries, agencies, municipal bonds, things like that. But really the theme of California Government Code and your investment policy is very high-grade securities that, these are reserves, these are operating funds that are needed for the district. The district isn't a hedge fund to go out and buy stocks and things like that. These funds have a purpose. They have a purpose maybe in a short term or maybe even a longer term period. And really what we're trying to do is allocate those funds and where you have different projects maybe in the future and be able to earn an adequate return for those different securities. So what you can see here is the darker green line there is the 2-year U.S. Treasury note. The lighter green line there is the 5-year, and then the tan line there is the 10-year Treasury note. And here's the question of the day: Can you give me a common theme that's happening in the U.S. Treasury note? All those lines are getting closer to one another. So you really don't get paid much more from going 2 years up to 10 years. Typically that's not the case, and I'm going to show you that right on the other graph on the other side. If you look on the bottom, those are the terms to maturity, and then on the side there are the yields of U.S. Treasuries, going from a 3-month Treasury bill all the way out to a 30-year bond. If you looked from a year ago, that's the lighter green line, you got paid a significant amount from going 3 months all the way out to 30 years. If you look at that darker green line there, which from June 2018, you can see that now that has shifted up. from that point of view. So you don't necessarily get paid as much for going out. And then if you look at that tan line, it's basically been a parallel shift from that. Also, what's happened in that same period of time is we've had the Fed increase rates over that period of time too, which has also affected the yield curve over that time. Today we have a relatively flat yield curve. It's still not inverted. You'll probably hear about some of that in the papers and things like that. People talking about, will the yield curve invert? What does that mean for the economy? Still hasn't inverted yet. We still have a pretty decent amount of space between those different maturities. But that's something definitely we look at your portfolio when we're investing in your portfolio. Where are the opportunities? When we have those opportunities, where should we place those on the yield curve? And so we use that in order to really achieve your objectives in this portfolio. Any questions on the economy?
We're good.
Perfect. Now let's talk a little bit about the objectives of the district. Safety, liquidity, and finally yield. Those are really the objectives if you think about what these funds and how these funds should be invested. So we have a performance objective. We have a market index in which we want to equal or beat over a market cycle. I usually think of market cycles 3 to 5 years is typically what a market cycle is. And then really the strategy is to invest the securities into those securities that meet the California Government Code and your investment policy. So that's really the criteria. One of the items that we're doing is really managing your portfolio to the overall investment policy. So you can see here all the different criterias. You can see the standard that we're using, and then you can see that they comply. Remember that the policy, when you purchase securities, it complies at time of purchase. So you could have some changes that happen. It's about whether it complies at time of purchase. Then also looking at page 15, this is looking at portfolio characteristics. And so what I'm going to look at here is here's our benchmark. And you can see the benchmark is what they call the ICE BAML 1 to 3 or U.S. Treasury Index. Think of it this way. Everybody talks about the stock market when they say what's the benchmark for the stock market. It's either the Dow or the S&P 500. So what have we done? We've chosen a benchmark that really simulates for that for your investable universe. So it's made up of all Treasury securities between 1 to 3 years. So that has an average maturity of 1.87 years. Your portfolio has an average maturity of 1.96 years, so a little bit longer than that of the benchmark, but it's definitely still within the range. Then we have something called modified duration. All you need to know about duration is basically it's your portfolio's sensitivity to interest rates, and it's also very close to that of the maturity. And so the more that you have as far as that number, the greater, the more sensitive it is. The lesser that number, the less sensitive. Think of it this way. If I bought a 3-month U.S. Treasury bill, and I held that for 3 months, I know that I can reinvest. So whatever happens with interest rates, if they go higher or lower, I'm able to reinvest. I don't necessarily have to wait that long. If I buy a 30-year U.S. bond and I wanted to wait for maturity in order to reinvest that, well, interest rates are going to play a havoc on that price over that period of time. And so when we look at your portfolio, we really want to look at having a benchmark that is appropriate for your risk profile that includes not only liquidity, but also looking at what the long-term needs are. So what we've chosen is the 1 to 3 year benchmark, which has an average maturity of approximately, let's just call it 2 years. Your portfolio, the duration of the benchmark is 1.8, yours is 1.75. The average purchase yield of the portfolio now is 2.09%. As of 6/30 is 1.83. As rates have increased, as we've had maturities, as we've had new money to invest, we've increased that yield as the yield in overall markets have increased over that period of time. The average market yield is 2.81. The average quality of the portfolio is AA+. The portfolio is $39.2 million versus what it was on 6/30, which was $30 million. Remember that this is just the amount that Chandler is managing for you. So you may have seen investment reports where you have a higher number. That's because some of those funds are internally managed. So this is just the portion that Chandler has managed. Also, I didn't make $9 million over that period of time investing in bonds. So what happened is you gave me about $9 million over that period of time. So I would say we earned about $180,000 over that 3-month period, over that period of time. So you have to keep those contributions and withdrawals into context there. Any questions here?
Just real quick, how close are we to the maximum amount that we're going to be transferring over to you for management?
I think we are still at 21 million in life, so we still have, getting down to about 15, so I think we have 2 more transfers.
Another 2 transfers of $3 million each.
Yeah.
Right.
to channels.
So 6 million.
And maybe that's something we should stop and what we discussed with staff and we came up with a plan is, so you had some extra funds that were basically in liquidity that we could actually push out and put into a longer term strategy and earn some more money for those funds. One of the things that we all knew that interest rates had an upward bias to that. So instead of just saying, okay, well you have $15 million, let's put it all in the market on day one, we decided to do that on a periodic basis of $3 million increments over the next 6 months, in order to not necessarily put all of our money in all at one time, but to basically diversify that as far as when we're purchasing those securities over that period of time, so that if rates were to rise, we were able to take advantage of those new funds
I
and
have
put those
a
work.
quick question of Wes. So Wes, looking at our financials coming up, and especially our PERS contribution, what we owe, do you work with Chandler, or do they have anything to do with any of that, or
No.
that's strictly an internal decision?
Yeah, separate number.
That's the way to put the money. Okay. You know, we have a PERS obligation, as everyone does.
Mhm.
We'll be looking at how much we need to pay off for that versus investing,
Mhm.
which doesn't do you any good, but could save us a lot of money.
You're not the only one. So you're not the only one in town that has those obligations, and everybody is struggling kind of how to do that and how to systematically do that. So.
Director Martin, just for information, next month we'll be bringing forward information on PERS. We have a new actuarial report that the board has not seen yet, so we're going to bring an update to the Finance Committee in November.
Okay, thank you.
And then looking at the sector distribution. And so this is looking at the different types of fixed income securities that the portfolio earns or owns today. One of the things, or the big thing I wanted you to take away from here, we're using all the tools in our toolbox in order to get that return for you. And one of the things that also is a hallmark of very well-managed portfolios is a diversified portfolio. A portfolio that has lots of different types of securities, in the sense that as you have more different types of securities, i.e. not putting all your eggs in one basket, typically that will reduce risk of the portfolio over time. And so what you're looking at now is the portfolio has about 48% in agencies, about 1.5% in commercial paper. Commercial paper is just a short-term corporate obligation of a very high-quality company. Toyota Motor Credit, Honda Motor Credit, things like that, high-quality companies. You have a money market fund, which is a small percentage, 1.5%. Negotiable CDs, these are certificates of deposit, make up 11% of that. Supranationals make up 3.8%. I'm going to explain what a supranational is. It's essentially an agency that's in Washington, D.C. based agency. It's AAA rated by S&P, Moody's, and Fitch. And what this agency does is typically an agency of the World Bank, of one of those types of agencies. There's 3 of them that we can purchase in California per the California Government Code. And the reason that they're Washington, D.C. based organizations is because all the legal and everything that happens with that organization stays in the U.S. They are different shareholders of those different agencies, so this is a consortium of agencies, and typically what they're doing is helping in humanitarian efforts. But what they really provide you is really high quality securities that you can purchase for your portfolio that have the backing of the government. And the United States typically is the highest shareholder, especially in the Washington, D.C. based organizations. It's a relatively new asset that was added to the California Government Code back in 2015. California Government Code does not change very often. So when I say new, that's already 3 years old. So you can see how kind of it doesn't change very often at all. But this is something that we've incorporated in the portfolio. Looking at corporates are 11.1%, U.S. Treasuries are 21.1%, and what we call asset-backed securities, these are essentially loans and things like that of autos and things like that are put together, are 2.1% of the portfolio. So
Jason.
using all those tools and toolboxes.
I'm sorry, Jason, if I can I ask you to address the change to ABS, AB
Sure.
1771?
Sure. So there's a new law that was put into place, and what it does for asset-backed securities is asset-backed securities, in order to qualify as a permitted investment in California Government Code, had to maintain 3 general characteristics. So it had to have a maturity of less than 5 years. The security must have been AA or better by a nationally recognized rating agency. Think of that as Moody's, S&P, or Fitch. And also the issuer had to be rated A or better. The new law that has been passed and has been signed and will go effective January 1st removes basically the issuer constraint of where it has to be A rated or better. We, how we manage portfolios, will continue to buy high quality securities, and will likely include that in our own analysis, even though the California Code does not, because we think it is something that's very prudent for the agency in order for it to have issuers of those securities. Even though they're rated AAA, we would also like to have the issuer of those securities be a very high quality institution. But we will be working with staff. Today, your policy says that it needs to have that A-rated issuer, so we have no problem leaving that in there if you want to be more conservative. But if you want it to be a little bit more like the state code, definitely we can provide you with language in that policy in order to look at and review. And then moving over to the portfolio, looking at the different issuers that you have in the portfolio. And so you can see that's a very, very broad, diversified mix. What I will point out in the very top there, you can see U.S. Treasuries make up the largest percentage of the portfolio. Then you can see that it has the agencies. Also, you have Fannie Mae, Freddie Mac, Federal Farm Credit Bank, and then you can see the supranationals, and then you can see the other different issuers there. Also, look at their percentages. So when you look at anything that's not a government type securities, notice that it goes down below 2% in all those different categories. So you're looking at a very, very well diversified portfolio that has lots of different companies and also companies within different industries. If we've learned one thing from the great, kind of the Great Recession, is if we owned all financial companies, we didn't sleep very well during that period of time. So if you look at some of the companies that are in here, we have Walmart, we have Oracle, we have IBM, we have John Deere, we have lots of different companies in there that provides us with that diversified industry mix at the same time.
Are there any non-federal agencies?
Not that you can really invest in.
Okay.
Not that issue real securities. You could say the supranationals are an agency, like an international agency, so they may not be federal in that standpoint, but with the U.S. being the largest shareholder there, it almost gears itself towards that. So.
And does Chandler have any, I hate to say political influences on its investments in terms of, do they stay away from sin stocks like tobacco or alcohol or anything like that?
So when we think about that, and this is not necessarily something that's in writing, but more of our culture, and I think that's even more important. When we manage money for public agencies, typically we're not going to buy alcohol, we're not going to buy any tobacco stocks, and we're not going to buy any firearms. And the reason that we do that, if you think about it, some of your programs affect school children. At the end of the day, you may be funding a program to stop teenage children from smoking or from being in alcohol. So do you really want to invest in a company that's doing the exact opposite of that? And so we don't necessarily put that within the policies, but if you look throughout any of our portfolios, we do not own those types of companies. And the reason being is because your culture and your mandate is for the public service and for the public good. So in that, it's not necessarily written, but as a culture, we don't necessarily do that for those portfolios.
Thank you.
Where are you seeing the biggest spread right now?
If you look at it, the biggest spread today is, and it's usually typically this way, is in bank stocks, or not bank stocks, but bank bonds, and those bank bonds that are in Europe and things like that. So if you have European bank bonds, things like that, because the economy is slower there, financials typically have wider spreads than industrials because the business model of an industrial and the financial is different, and also there's still kind of the tag or the taint from the financial crisis that still is in there. Even though we have such high regulation from the financial crisis, from Dodd-Frank and things like that, that has really actually increased the overall credit quality of the financial institutions. Typically what you're going to see in our financial institutions, we're at that top tier, some of that being from California Government Code, the other being is that we think it's a suitable investment for a public agency, and we don't think that taking very much risk by going down the credit spectrum is really a good idea for that.
What does the spread mean?
So the spread means, so if you have a treasury today, I'm just going to use some round numbers, a 2-year U.S. treasury, let's say that you can earn 2% on that. Well, in order to entice you to buy a corporate security, which we know has some more risk, but not a ton of risk, but a little more risk, they have to pay you more yield than that. So what we call that is the credit spread. So today, if I bought a JP Morgan bond, and that yield was 2.5%, and the treasury was 2%, that means that 0.5% that I own is the credit spread. And then looking at the average quality, this is looking at an S&P scale. Notice that you don't own anything that's less than A, and also those non-rated securities there are either CDs that are less than 250,000 that are insured by the FDIC, or they are securities that have another rating either by Moody's and or Fitch. This is just looking at S&P. And then here you can see the duration distribution here. You can see in the green is as of September, and you can see the tan is as of June. And you can see that we, even in this rising interest rate environment, we probably have an additional 30% that's going to mature off in the next year. And so that's allowing us the opportunity to reinvest some of these assets into this higher interest rate environment as we go along. Along with that, if liquidity is needed by the district, it's also supplying that liquidity. So going along those primary tenants, safety, liquidity, and finally after those two have been met, you get a little bit portfolio. And then here you can see the total return over the last 3 months. And so you can see the green line is the 3 months is your portfolio. The tan line there is the index. And so you can see over the last 3 months, your portfolio has earned 40 basis points versus the benchmark, which earned 20 basis points. And since inception, your portfolio earned 75 basis points versus the benchmark, which is 57 basis points. It's a short time period right now. Performance started for this portfolio in April of 2018. As we continue on the relationship, you're going to have different time periods that we will show you over that period of time, so you can look at that versus that. I am also going to take a step back, is that we've been talking a lot about yields recently. So what this slide is really showing is really what we call total return. So what total return is looking at the value of the portfolio, meaning as interest rates increase and decrease, the value of those bonds increases and decreases, plus whatever earnings that you've earned on that portfolio. And so what that is it's looking at a better measure of your overall portfolio and how that's growing, because it's looking at the entire portfolio, how that is growing, both the realized and unrealized gain loss along with the interest that's being earned, and it looks at that over time so that you can look at that versus your benchmark. Where yield is just measuring basically the earnings off of that portfolio, but it's not looking at the overall value. So we think it's a different measure to look at, and one that has a little bit more information for folks. And then here you can see the reporting balances. Basically this is either in cash or in LAIF. You can see the average purchase yield there is 2.07, and you can see that that balance has decreased as of 6/30 from 33 million to 26.5 million. Some of that was moved over into the portfolio, and there's probably some other expenditures that came out of those funds too. And then you can see how that's allocated. So basically you have 80% in LAIF and 19% I believe in Q.
Yeah, that kind of, yeah.
Yes. And then you can see the consolidated information. So when you consolidate both of those together, you can see that as 9/30, you can see the average maturity there is 1.17, duration 1.05, so less than about 1 year. The average purchase yield 2.08, market yield 2.51, AA plus portfolio, and there's the bigger number there, $65.7 million. And you can see how that's allocated. The only difference here now is you can see that LAIF is 32.4, and then you can see the county pool was 7.9, but then all the other percentages shrink because of that. And then I have the portfolio holdings here, and I can answer any questions that you may have.
That?
All right, that concludes my presentation.
Great presentation.
Well, thank you.
Very much. So does that mean that we as staff are very happy with the performance?
It does, especially Anthony.
Lives up to expectations?
Yeah. It's a lot of accounting to do with all these investment purchases, but it's good. It's fun to see all the different things that you're purchasing. And the biggest takeaway for me is, what we were invested in a couple months ago versus now. The diversification has just done a total 180. So,
Oh, really?
yeah.
I was hoping to call you last week to have you help me with my $1.5 billion. I missed it by 6 numbers.
You and I both.
We all tried ourselves.
Well, thank you very, very much. I really appreciate that. That's a lot of information.
Great, thank you very much.
I'd like to just extend an invitation to members of the staff and directors. Kara and I will be attending the Aqua Conference next month now, tomorrow, but November. And November 27th at the top of the market in the San Diego Harbor, we will be hosting a dinner for our friends who are attending the APA conference. We hope that you will join us, and so we're going to leave behind a few flyers.
Okay.
And I'd like you to just share those with the other members of staff and directors, and hope you can join us. Jason will also be attending that dinner with us.
Mr. Hunsaker, do you have a question?
Yeah. Are these just gross income levels and such that you're reporting? Does that include your fee, and what are your fees?
So they're gross of fees, and our fees are really predicated on the portfolio amount. And so the highest that would be 10 basis points.
10
And
basis
it goes down from there.
Down from there.
The more assets that you have,
Right.
there's different tiers in that fee schedule.
You mentioned the lawsuits for getting around local control and such, and my wife and I own a property in the city of San Diego,
Mm-hmm.
and it's in one of the proposed transit priority areas. And then all rules are off, essentially. So, and we're a prime area in San Marcos for putting in these TPAs. And I think that needs to be considered somewhat. Now, the IMF and the Bank Clearinghouse in Europe was mentioning, they think there's going to be another crash, a recession, coming up in 2020, 2021. And that this is going to be led by municipal bond crunch at that point. So wouldn't it be wise to sort of shorten the maturity a little further, or make a mention as to what the impact will be when Vallecitos Water District has to go out for bonds? The other thing is, you mentioned long and short-term rate inversions. That is usually a precursor of crash and such, and these are really dramatically tightening. And 2007, I guess, it reversed and there was an inversion
Mhm.
because of the cash crunch, right?
Right, right. So on the speaking about if there were to be some sort of financial stress in the sense that we went through a recession, it's actually counterintuitive, but you would actually want to be as long as you possibly could in your overall average maturity, because the expectation would be that rates would fall, because the Federal Reserve would then come in and start to basically buy treasuries, bring down rates, especially on the very short end of the yield curve, in order to stimulate growth. So although counterintuitive, if you were going to see, or you could foresee a recession, you would want to buy probably some of the longest bonds that you possibly could in order to take advantage of that.
Assuming that the feds can do that effectively again.
Mr. Hunsaker,
Yeah.
just stick to your questions.
Yeah. And you use national inflation rates, but California is much higher, isn't it?
It depends on where you are, but typically California is higher than the national average. Not too much higher though. But it
Okay,
is
thank you.
Thank you. No other questions? Thank you very much, folks, for coming. Really appreciate it.
Good to
You're
see you
right.
again.
Yes, take
Thank you
care.
very much.
Okay.
I look forward to seeing you on the 27th.
Yes,
right, great.
absolutely.
Will RSVP?
We sure hope you
Yeah.
do, yes, absolutely.
Thank you very much.
Yeah, we'll take a head count. and find out
Appreciate it.
what's-
Thank
you,
Bye,
guys.
have a good one.
Thank you.
Bye, thank you.
Thank you.
I have a feeling he's done those economic indicator
Oh, yeah.
presentations
Yeah.
before. Yeah, very smooth.
That was pretty well done, Pat.
Yeah.
Okay. Thank you, staff, for putting that together for us. That was quite interesting. All right, gonna go on to item 2, reserve level report.
I'll kick that off really quickly. So Director Martin, you may remember that every month we have a report about the reserve levels. One of the problems with that report is it's just a point in time. So we thought it'd be helpful to have something that takes a look at our reserve levels over time to see if they're trending up or trending down. So I've been working with the finance group to try to come up with a tool that'd be more useful for the board to see how our accounts are doing over time. So with that, I'll turn it over to Wes.
I don't want to take full credit for this. Anthony did most of the work on this report too, so just so we have that out there first. We put together the grass. He did a nice job of preparing the report. But what we've got today actually is two different versions of a report that we're looking at putting in the board packet for you on a quarterly basis. So we'd like to just kind of talk to you about this and get your feedback on what you prefer to see. The first one we'll talk about is, we'll do the long-term one first, and that's the one that has the years underneath the grass. So if you look at the graphs, they show 2013 to 2018, and yes, that's the one right there. So this is the one we'll be discussing right here first.
Okay.
So that one actually shows, this is a quarterly report for September 2018. So each one of the years, so for example, 2017 is September 30, 2017, 16 is September 30, 2016, so on and so forth. So it shows that point in time 5 years back. And what this does basically, it says, our reserve policy establishes replacement reserves with a ceiling of 10 years and a floor of 3 years based on replacement needs. And these are just the summary of those reserves and how they compare to the floor and the ceiling in the first chart, which shows all the replacement reserves, the total balance, where it relates to the floor and the ceiling. Then it goes into water replacement, talks about the balance there, how it's changed. Then we'll talk about the wastewater replacement reserves, and finally the capacity reserves. So it's kind of a summary and discussing each section of the reserves, so you can see the trend line over the last 5 years. So that's the first version. The second one is very similar, but what this does is it's more of a short-term view of the reserves. This just shows the last 5 quarters. So in this report, we're just discussing the current balance and how it relates to the last 5 quarters of the same reserves and the same breakdown. So looking at those two, you've probably just got it, and I don't know if you had a chance to look at it, but that's kind of like what we're proposing to present to the board, and just wanted to kind of get your feedback on and thoughts.
It's mostly the horizon. How far back does the board want to look to see how things are trending?
Mhm.
So you can see in both the water and wastewater replacement reserves where the ceiling is the black line, the
Right.
floor is the red line, and we're within the floor and the ceiling, and the trend is upward. So our replacement reserves are doing well, and we have sufficient funds to meet our infrastructure replacement needs. And this gives you the 5-year picture, so you can see over the 5 years, that amount's been growing. It's been growing because we have aging infrastructure. As the infrastructure ages, we need to replace more of it, and the floor and ceiling goes up with the line itself. And then the capacity reserves, that shows the deficit and the trend it's been doing over the last 5 years. But that section also discusses the master plan that will be approved shortly. I think it's March or April, and the capacity fee study that'll be done along with the master plan to address the deficit in capacity.
And keep in mind, Director Martin, whatever we put in there first, and we can't get direction today because Director Snell is not here.
Sure.
But we'd be certainly happy to hear your feedback. Staff will make a decision which one of these to put in on a quarterly basis, but we're at our sole discretion collectively between the board and staff to change that over time. If we think we're looking too far in the past or not far enough in the past, we can change the reporting structure.
Okay. So I'm not gonna give any direction. I like both reports for different reasons. I like the first one, especially looking at the capacity reserves, because it shows the decline from 2012 to present day, which is because we haven't had a master plan that we were supposed to have in 2012. It never got done by previous staff. Now we're getting it done. We're gonna be able to come up with our capacity numbers, as we should, after we can justify them. So I happen to like that one, I think it shows a better picture, but again, that's just a personal opinion. Okay, anything else, Mr. Hunsaker?
Let's see. In the past, the VWD staff has mentioned that some of these reserves were used to modify rate structures to keep them down. And I was wondering, it was noted that was not a proper use of reserves. Are we going to abandon that policy in the future? Or is that money available to again modify or reduce rate increases.
Well, the only thing I could think of that you're referring to is a rate stabilization fund, is that what you're talking about?
No, there was a direct statement in one presentation, these reserves should not be used for reserve rate stabilization, but we have done it in the past. Are we gonna do that again? Or are we gonna really mean these are reserves?
We've only had rate stabilization money one time in the time that I've been here, and that was rolled over into replacement reserves and used for rate stabilization in the budgeting period.
Yeah.
But we've only had it once, and it was for a couple months at the end of maybe 2013, maybe 14. I'm not
I
really sure.
think there was also 16 as well.
Yeah.
Well, we've only had it once, so
But
it was one of those 2
I
years.
took it by your answer to what I said is that you weren't referring to the rate stabilization, so if that's not what you're referring to, I'm not exactly sure what statement
Well,
you're
it was
referring to.
mentioning the maintenance fee reserves and such, and that it had been done, and it wasn't proper. And the capacity reserves, does this include or not include deferred fees?
I'm not sure, again,
So deferred fees are not accounted for. They're recorded here as a receipt. It's done on a cash basis.
It's a cash basis.
Correct.
Okay, so anything is deferred, does it show up at all in this deficit?
No.
It does not. Okay. And why do we have so much higher replacement reserves than just about any other water district?
I can't speak to other water districts, but what I would say is our reserves are based on our need for infrastructure replacement.
Yeah, but it's an arbitrary figure as to 10 times ceiling.
sure, it's a policy that's developed by the board as to how much money, the range of reserves we think we should have based on our infrastructure and the condition and age of that
Yeah,
infrastructure.
that's interesting, since we have some of the newest infrastructure. Thank you.
All right, if that finishes your bill. Electric costs.
Yeah, so at a previous, I can't remember if it was at a
Yes.
previous board meeting or a previous finance committee meeting, but the question was asked, what do we pay in electrical costs? So we had some preliminary information ready a while ago, but we thought it would be more beneficial to wait till we had like the last fiscal year available. And that's what you see ahead of you, in front of you right now. And Mike has done the heavy lifting on this. We have a lot of meters throughout the service area. This does not include all of them. This is the major users of electricity. That's what this is intended to reflect. We have some pressure reducing stations that have an electrical meter just so we can control through SCADA, and that may be 40 or 50 bucks a month. That's not on this list.
Okay.
But these are the big ones. So maybe just to go through it real quickly, and I think I have one extra copy if somebody wants to, maybe Mr. Hunsaker would like to take a look at it. So in the blue at the top, these are the 10 pump stations that we have. So the pump zone charges that we charge, each of those pump stations has a meter, and that's listed in here. So if you look at the summary, the total electrical costs in fiscal year 17-18, so the period ending June 2018, we spent $624,000 roughly annually for that period of time, and that averages about $52,000 per month for a pump station
And that's
charge.
strictly for the 10 zones that we have.
That's just for those pump zone charges.
Okay.
I'll get to the next one, it's water pumping in a little bit.
Okay.
So the next 4 meters are with our sewer lift stations. We have 4 sewer lift stations that are separately metered. The biggest of which is sewer lift station number 1 that takes water down to Meadowlark for conversion into recycled water. In between those 4 sewer lift stations, it's an annual electrical cost of $136,000. So just a comment on the annual electrical costs. Some of that is commodity, how many kilowatt hours you purchased, and the other is like standard, they're standby charges, they're fixed charges, just like we have standby charges
Right.
and ready to serve, so does SDG&E, and all of those costs are reflected in these numbers. So the third grouping, I don't know what color that really is, but it's the water pumps that don't take it up to elevation. So this is just basically moving it into our lower zones. How do we get the water into our service area without having to pump it up to higher elevations? So
Okay.
that's what this includes. So it includes a county water authority connection. The second one is the San Alejo pump station, which is how we get the water from Livenhain that we purchase. And then there's the Vallecitos 2, San Diego water connection. The only one that's of any substance in that is the San Alejo one. So we buy, about 2,500 acre feet per year, maybe a little bit more, maybe 3,000 acre feet per year of water that's treated by Livenhain. And this is what it costs to take it in from Livenhain's service area.
Okay, so this is what it costs. Well, we're not pumping it, they're pumping it to us, I assume.
It's our, yeah, well, but it's our facility that's pumping it. We pay the cost to pump the water over. We get a we buy the water cheaper than we could otherwise get it from the
Right.
county water authority,
Right.
but some of the savings has to be given to SDG&E to move that water into our service area.
But the pumps, that's not the pump out in San Alejo, this is a pump that's closer to the dam.
No, I think this is the one in San Alejo. It's the one off San Alejo Road.
So it's a suction pump?
What do you mean?
Well, the water you get from the dam to San Alejo Road, I don't know how it gets there. If it gets there by
I don't know if
gravity?
it could be gravity. I don't know how it gets to our pump station, but what I do know is we need this pump to take it from that pump station
Right.
into our service area.
But if it comes from the pump station up to San Alejo, then that should be part of their charge.
Right, it would be included in the cost of water. It would be it would be in their supply charge. And then
Oh, okay.
this is our transportation charge, what it costs to get in our service area.
Gotcha, thank you.
The only reason we include those county water authority ones, they're relatively small, but they were of the same type of pump station, so we decided to include them in
Put
the
the
category.
types in
And the last one is includes the single biggest hitter. It's what we call our facility electrical cost subtotal. We have the Meadowlark Reclamation Facility, which is our single biggest consumer of electricity in the service area. And then we have the Vallecitos headquarters where we're currently at right now. So between the two of those, it's $600,000 a year in electrical costs. So the total electrical costs last fiscal year were almost $1.5 million. So
My question's gonna be, now, at Meadowlark, and this is, do we actually show dollars and cents what it costs us to operate Meadowlark versus how much we get back from Levenheim and Carlsbad?
we do. We're in a very extensive process. We've been having multiple meetings with staff internally, including operations, finance, engineering, and myself. All four of us are getting together and trying to get to the bottom of this. We have a little bit of difficulty in that Meadowlark only has one electrical meter. So everything all the electricity that goes through there goes through one meter. But there's two processes taking place. One is secondary treatment, which we need to do regardless of whether we produce recycled water. And the second is tertiary treatment, which takes it to recycled water level that we can sell in compliance with Title 22. We don't have a sub-meter to know exactly how much energy the tertiary process uses. What we've done is look at the pump ratings, how big are the pumps, how often do the pumps run, and we've done our best estimate. We are contemplating putting money in budget next year to install a sub-meter that wouldn't be read by SDG&E, it would just be for our purposes. We would still get the SDG&E bill for the whole
Right.
facility, but we'd be able to know how much was for tertiary, how much was for secondary.
So in order for us to make it to secondary, do we have to do that before it goes to Meadowlark?
Well, we have to do it, if you want to produce recycled water, we have to take it to secondary treatment and then do one more stage to get it to tertiary.
Okay, so that still is a cost in creating the water for Carlsbad and Levenheim.
Well, no.
Because without Carlsbad and Levenheim, you wouldn't need to do that.
Well, you would still have to do secondary treatment to be able to discharge it into the ocean. So it has to be treated secondarily.
Oh, but I'm saying instead of just discharging it to,
Encina.
Encina.
So that's the other thing, we factored that in too. We could probably do it cheaper to just we could get secondary wastewater treatment cheaper at Encina than we can do at Meadowlark. So there has to be some acknowledgement of that if Carlsbad and Livenhain want us to produce tertiary, not only do they have to pay for that third stage, they have to pay more than we would otherwise pay for secondary treatment. So that's in the analysis as well.
okay.
And, you know, from a timing perspective, we're trying to crunch the numbers. We think within a month we'll have our latest numbers done, and then we'll start negotiations with Carlsbad and Eliminate in terms of what we think should happen to the existing agreement and the price contained in the agreement.
How
So,
long is the agreement right now good for?
25 years, I think. It started in 2000, I want to say 2003, and
Wow.
it's about a 25-year term. So it's got a long way to go. But
But if we can show them something, we might be able to.
yeah, and I think there's room to do that. There's all sorts of exit ramps. People can get out of the contract if they want to for a variety of reasons. I don't think anybody wants to get out of it.
Right.
But we think the existing agreement is not particularly advantageous to us. So I would say that based on our preliminary results, we're covering all of our fixed costs, but we're starting to look in some of the allocations of overhead and indirect costs that should be included in the calculations. It may not be at this point in time. As we go through that process, we'll probably stop by the finance committee and let you know what the numbers we think we should be chasing before we start negotiations with Carlsbad and Eliminate.
And we still just have 5 employees down there full-time.
I think it's 6, it's either 5 or 6. I think it's 5 without Dawn, so there's Dawn and I think 5
Oh.
operators there. So that's it, and that's what they do. So, is that right? Is that the right body count?
I can look it up.
Yeah. I always forget if the 5 includes Dawn or not. I don't think it does. I think it's,
But Dawn, that's what she does, I mean, that's her whole thing.
she's the supervisor of that whole group, and then she has 5 operators. I'm pretty sure it's 5. So we hope that this addresses the concern.
Yes,
Obviously, Director Martin, you know we're in the beginning stages of this district-wide solar generation. This information has been shared, information like this has been shared with our consultant, and that's how they're sizing the facilities to
Yep.
determine how much of these costs do we think we can offset with a location-specific one or a district-wide solar study.
the VWD headquarters building, last year, we weren't using the solar, is that correct?
Correct.
That was down already. Do we know how long it's been down for?
I want to say a year and a half.
I think it's about that,
Yeah.
about 18, 19 months.
And we have no solar at Meadowlark, nor is there any place to put it, I'm assuming.
That would be a tough site to include solar.
Yeah, I don't know.
You don't necessarily have to have the solar on the site to use the account for it. That's what we're talking about, the new solar study.
Yeah.
So they can put it where the reservoirs are, and we can still use the Meadowlark accounts.
Yeah, so there's 2 ways to do it. One is called a, I'm trying
Power
to
purchase
remember.
agreement, PPA.
Well, no, it's not the power purchase agreement. There's it's basically an offset. So let's take lift station 1 location. You could put solar there, and the energy you generate there could only be used to offset the power consumed on that site.
Right.
That's one way to do it.
Right.
The other way to do it is it's called a RESBCT tariff rate, and that lets you generate as much as you want at one location, and you can offset the demand at up to 50 locations. So that's what Wes is referring to. We could build a massive solar array way up in the north area at our Twin Oaks underground reservoirs, and the power generated there could offset the meters anywhere in the district that we want up to 50 meters. It's usually not as preferable, it's not as advantageous as direct generation, but it has economies of scale, and it allows you to offset when you don't have the physical land to put in solar facilities.
A little late to ask this, but I'm guessing they did. Did they happen to look at the 2 sites which we have on hillsides, which are acreage up on the north and Coronado Hills?
They did. They looked at those, and they were pretty quickly rejected because they don't have the infrastructure out there. If you generate a large amounts of solar, you have to be able to get it to the grid,
Right.
and the cost of installing towers and lines offset any benefits you got from it. So they look for places that have a lot of real estate, good sun exposure, and good facing slopes, and easy access to infrastructure.
Right.
The good thing about North Twin Oaks is that the water authority had to do a lot of investment because they have solar energy there. They paid for a lot of upgrades to the SDG&E distribution system, so we can tap into that and take advantage of the investment made by the water authority.
I know we had the presentation of when we looked at putting solar up there, do we maximize as much as we can put out there?
Pretty much. I mean, we're looking at how much demand we think we can offload, and then we sized it based on the amount of real estate we have there. And if you've seen, I think you've seen the pictures.
Yes.
Those tanks are almost completely covered with
Right.
solar photovoltaic.
Yeah, great. And the engineering was already done to make sure those tanks can hold that kind of weight
Yeah,
and
we're not,
force that could be on it?
not worried about that at all. That'll easily withhold the weight. The solar tend to be pretty low load bearing.
Right.
So I'm not too worried about that.
Great, thank you very much.
So this is something we
It's
can
a lot
track
of
on
work,
an
but
annual
yeah.
basis.
Just to let you know, he was, General Manager Prum was correct in saying that we have Don and 5 treatment operators at the plant.
So there's 6 people that operate that
Correct.
full-time, that's the only, they check in there, check out there, they don't come up here for any reason other than.
They're training,
Meeting or training or
things like
something.
that, yeah. Yeah, we don't see them too often. They come and get their awards at board meetings, things like that, their certifications.
Until we ask them too many questions, then they'll never show up.
Then they'll never show up again,
Yeah. We're in for a barrage. Okay, we have one question from Mr. Hunsaker again.
Yep. By the way, I want to compliment the district on its recent water tour.
Yeah.
I thought that was very comprehensive, informative. And if there's any one little improvement I would put, we first have all those people just pile off the bus off Metal Arc. I'd explain primary, secondary, and tertiary with examples of the beakers right up there. Because you split people off and they get it in different phases, it's a little difficult for the
Yeah,
average
funny you say
citizen.
that, because I had that exact conversation with staff, and even if you go in the right order, people tend to forget, okay, now that beaker, where am I at in the process? So I think
Yeah.
we can better connect the process with the tour.
But very well done.
Yeah, thank you.
Overall. And on the Metal Arc, which is a very fascinating part of the tour, there was mentioning, well, we sell this stuff to Liebenheim, and I saw another presentation of, we're under the gun because the current market value of water is a little less than what it's costing us to produce it. So there's gonna have to be some sort of adjustment if we're getting anything. But the other thing is, the Liebenheim water that we get back, that's not drought proof, if I'm not mistaken. Now, if we get into a drought and they cut us off, are we still required to sell that water to them at a favorable price and not get back the water we send them?
The agreement for the recycled water purchase agreement you're
Yeah.
referring to, it basically says if flows are available, we will produce it. But if something causes water to not be available to the Metal Arc facility, we're not obligated to provide it to them.
But if it is available, but they cut us off from the water that we buy, wouldn't we be in a little bit of a problem?
Not really. Well, if Liebenhain didn't provide us with potable water, we would just purchase an equal amount from the county water authority, and we would just pay a slightly higher rate. I think our agreement with Liebenhain says we'll pay them 80% of the treatment costs that the water authority charges us. So we pay the same kind of basic commodity rate, the metropolitan rate, and then we either pay the water authority treatment rate or 80% of that if we purchase it from Liebenhain.
Okay. And lastly, I'm still an advocate of power storage, big one. Thank you.
Well, if nothing else, committee, great job, thank you very much. I'm sorry Mike couldn't make it.
Yeah, and if you have any thoughts for next month, like I said, we will have the PERS rates on there. If there's anything else that you,
I would like to find out if it's gonna be possible next month to move it up, because the last week of the month we have Aqua.
we can do that.
So if we move it to the 19th,
Okay.
which is a Monday, or Monday is the day we're trying to stick to, I thought. I'm glad we didn't just yesterday, this would have been. Who beat you up, Al? Everybody. Guess if we do that on the 19th, that'd be much better, or anytime that week. Cause I know we went back and forth to Aqua. I think everybody's going for it, I saw the sign-up sheet.
Well, we'll look for a date that works for staff, and then we'll coordinate with our 2 finance committee representatives and coordinate.
And by then we'll know what's going on with Mike.
Yeah. True that. Yeah.
Thank you very much.
All right.
Adjourn the meeting. Thank you. Thank you, Mrs.
Thank you.
Vallecitos. Very nice seeing you.
Hey, I like the new Halloween accessory.
Yeah, I'm gonna draw little whiskers on it or something.
Hey, I think it looks good.
Yeah.
Thank you.
Thank you very much. Excellent information, very well presented. And thanks for having them all here, that was very good.
Yeah, I'm surprised they sent all three.
Me too, I didn't expect that, I thought it was just gonna be JC.
Oh, we should have said this before, but how often are they obligated to come and give presentations?
I believe they'll do it quarterly, but they seem like they'll do it pretty much whenever
That was
requested.
one quarter.
Yeah,
Maybe next quarter.
you wouldn't need it
every.
every month, certainly.
No.
Even every quarter, particularly with a lot of the
Yeah.
bigger picture stuff. We may want to know specifically how did we do this quarter? And then every other quarter, maybe have them come in and talk about changing economic indicators.
Do it once
I
every
didn't
6
wanna ask you
months.
something, but how did we do the quarter before that? I know things changed, we got 180,000.
Amazingly, we did amazing the quarter before that.
You don't know.